Hi everyone, we've got a weekly bumper stock market update today. You're going to love this. You'll want a pen and paper because you're going to want to take pictures of some of the things that I'm going to go through. It's not the usual one. There's a heck of a lot more information, including some slides on the most important things that I wish I knew 20 odd years ago. So not the usual weekly stock market update. Hope you're ready for it. Let's get ready to rock and roll, as they say. Well, that's what I used to look like back in the day. As you can see, I've aged somewhat. At the bottom, if you want to WhatsApp my team for some free education, pointers, tools, it's all free. It's down there. I'm also on LinkedIn. Sorry, the LinkedIn logo has sort of managed to remove the full URL, but I'm on LinkedIn under Alpesh B. Patel as well. That's where we're based out of. What you need to know, and some of the things I'm going to cover today, stem from not just the stock market update, but from where I learnt some of the most important things. When I wrote my very first book published by the Financial Times, Lessons in Trading Strategy from the World's Leading Traders, one of the most important people I interviewed was Bill Lipschutz, who you can see on the left there, Hedge Fund Manager of the Year recently. His boss at Salomons was one Warren Buffett. So I'm going to give you some of the top instructions that I learned from him that are published in my book, that are published by the FT, no less. Okay. The other thing that I'm going to share with you is a summary of the most important things that I've written about in the past in my Financial Times columns. And I've done over 200 columns in the Financial Times, 300 shows on Bloomberg TV. So I'm going to share with you all of those insights in this as well. And if you have seen me elsewhere, whether on the BBC or through my books, you'll be familiar with the education as well. And I hope you're going to find this great. Like I said, please do connect with me on LinkedIn as well. That's my team and a whole bunch of very exciting, interesting things that I've done in the past. My colleagues that I've worked with in various roles through government and through the hedge fund industry, and it's been rather good for me. So I'm going to share some of that with you. I'm also going to share with you why sometimes it's so difficult to understand what's happening with the stock market, not least because of Algos and AI. Those are headlines from 2019. Okay, we're 2025 now, November 2025. And what I'm going to share with you is just how so much of this stuff has continued to be blindsiding private investors. If you take this from 7 years ago, Stan Druckenmiller, who was the person who taught George Soros everything he knew, he said algos are robbing markets of trade signals. AI is doing it even more so. So I think investing has become more the route to go to for private investors. And the reason being, as a private investor, you can stay out of all the noise that the algos create. Whereas I know on social media, there's a lot of people who want people to get into algo trading. I think it's become increasingly difficult for the private investor. And what I'd say is that if you look at where you should be, like I said, I really think it ought to be very much at the investing end of things. It is no wonder, therefore, forecasters are finding life a lot more difficult. So we're going to focus on what I like at the moment in the markets for investments. And investments usually means at least 12-month holds. Now, I know that's not as sexy as, of course, trading in and out, and I'm sure many of you would love to make lots of money out of flash crashes and the like, as you will have read about here. But the fact of the matter is investing is what most people should be doing. Also, what I'm going to do in this is I'm going to share with you some of the research that we've relied on over the years. And like I said, I'm going to bring it right up to 2025 as well. We're also going to look at pattern recognition and how private investors can use that for investing, not for trading, but for investing. What we mean by pattern recognition is we're looking at what's happened in history, and whilst it's not guaranteed to repeat itself, can we use it as a probabilistic tool to come up with a hypothesis that when this happens, this is likely to happen. There's many ways of doing it. Thanks to AI, that's become easier. So I'm going to share with you some of the companies, of course, that I like and where on pattern recognition we are, say, on the S&P 500, which you'll all be familiar with. What you've got to remember is all decision making comes down to what you can see on screen there, whether it's who should you vote for or anything else. It comes down to what's important, how important is it, okay? Whether it's who to marry, who to vote for, what stock to buy. What's important, how important is it? The problem that most people mess up is they either don't know what's important or they get the weighting wrong of how important it is. Okay. Now, if you were trading, and we're not going to talk about trading in this, but I just want to show you, if you were trading, you might think, well, I'll do 100 trades. I'll put a stop loss and a win loss equidistant from the entry. And what would tend to happen is what you see at the top. You'd end up with a net zero return. Trading is about just trying to skew those odds slightly in your favor. Okay. Investing's different. Investing is holding for a longer period of time where the probabilities are not 60-40, but are significantly better, but they take longer to achieve. Time is money. That's why a lot of people don't do investing and they run around trying to time the markets instead. Now, you might say, well, wait a minute, why are you teaching all of this? And why are you telling us what hedge funds such as yours do? Well, it's not a secret. The scarce resource is not the strategies that a hedge fund deploys. The scarce resource is now and has always been the ability to raise capital. So hedge funds like Man AHL and others have in broad terms explained what it is they do, because they have to in any event. And this is taken from Man. This is from one of the biggest hedge funds in the world. They have to explain what they do to their clients. For a start, the problem has never been that. The problem has always been that private investors haven't had the capital to begin with. And again, that's why I want us to move further away from the trading side, more from the investing side, because what I've discovered over the years is that the people who go into trading are the ones who go into Ladbrokes, the ones who play the lottery. They're the ones who can least afford to do it and the ones most likely to lose money. And that's why, again, I want to shift you more towards the investing side of things. Okay, whilst I've written books on trading and trend following in particular, every single one of these are trend following hedge fund managers, and you can see how they've done well. By the way, you might recognize John W. Henry. He owns Liverpool Football Club. For instance, Sir David Harding owns Winton Capital based out of Hammersmith and is one of the largest hedge fund managers in the world. But that's not the point. Trend following as a trading activity is fine, but investing is probably what private investors ought to be doing more of. Again, if I show you what Winton Capital do, what you can see there is a slide which is taken from them. It's not one of mine. It's taken from them. And what they're explaining is that after a lag, they buy, after a lag, they sell. When it comes to investing, we're going to look at the valuation of companies, the dividend yield of companies, and so on. So it's a very different activity. And I wanted to differentiate the two because most people don't understand the difference. And we're going to very much focus, as I said, on the investing side. So I'm going to put these things to one side. By the way, the trader is looking for something or somewhere to light the match based on a pattern recognition. That's a pattern. They see some recognition. Boom. That's what they want to do. And they want to try and maximize these enters at the greens and exit at the reds. And they'll come up with a hypothesis based upon that. Now, that's a lot of time, energy, and effort. And what we've discovered over the years, whether it's the straw that breaks the camel's back and then you make profits from a fall. So if you get this kind of pattern recognition and you can say, right, whenever we get that kind of pattern, there's an increased probability, even a 0.1% increase in probability of a fall. However, private investors like gym memberships start off all confident wanting to do that, and they soon discover that they don't have the energy for it. And of course, we'd all like to be in the best paid hedge fund manager list. Let me also explain to you the difference between trading and investing. With trading, this is actually taken from Bill Lipshutz's own hedge fund. And this is what a professional hedge fund's distribution of monthly returns looks like. If you look at that, you'll see they have 4 out of 10, say, losing trades, 4 out of 10 winning trades, and a very few number, which are the large, big wins. It's the big wins that account for the returns. The small wins and the small losses cancel each other out, and their job is therefore to avoid the big losses and to be in a position to make a few big wins. Why isn't everything a big win? And this is the bit private investors have never understood, is because, well, of course, we'd all love it if we could be big wins, but we'd need a time machine or a crystal ball to be able to do that. So that was actually from a hedge fund, Hather Sage, which is Bill Lipschus's hedge fund. Of course, when it comes to trading, were you to trade as opposed to investing, and you can apply this to investing, then trend following tends to be one of the biggest areas, the most significant. I won't go into some of the historic returns of how this works out, but what I do want to show you is when I've applied some of the trading aspects to the investing aspects, trading to investing, as you can see here, then what has often happened is it's produced the best of both worlds. So I'm going to mix a bit of those up. As my clients will know, we'll try and ideally look for those smoother trends exemplified through what's called a higher Sortino, and I'll show that and explain that to you as we go forward. Okay, what I want to get through at the moment is share some of those years and years. That's when I had hair, and Merrill Lynch, HSBC, when they had an alliance, would use my research as well. I'm going to share all of the best in this webinar and this video, this TikTok live, wherever you're watching this. And you'll also find me on YouTube as well. So let me start off with the conventional stock market update, the weekly update that I do and what's happening in the market. So I want to start off with what's happening in the news. Now, the most important thing you need to be aware of is these companies are producing significant bumper earnings. As long as companies are producing earnings, we don't have a problem being in this market. Now, if I take you to some of what we're seeing on the earnings side, and I just put up even the news, then again, what tariffs? Tariffs are not a problem at the moment. AI bulls are waiting for Palantir. Palantir should continue doing well long into the future. I own some through one of the model portfolios that we have, but I'm going to take you through some more of this news to see how we look at it. We look at this to determine, is there anything particularly macro which suggests that the music is about to stop? And the biggest macro worry would be that there is no longer earnings, or earnings are decreasing significantly, or interest rates are going up. We are not finding that. Okay, we're not finding out in any of this news. Another slight worry is oil rises. Oil rises because the Indians are buying less off the Russians and are going to go into the markets that the West is competing in. So, because the West wants them to, so that's going to push up oil prices because the West wants them to buy oil from them. And from the Middle East, as they used to. And OPEC at the exact same time, which was obvious because it's a cartel. Cartels are criminalized in the West, but they're not in the Middle East. OPEC as a cartel has decided to pause output. Okay. And that's going to spike up rates just as we go into a Western winter so they can maximize profits. You'd expect that. But the West definitely said, no, we will do whatever it takes to, we'll take any pressure, any high interest rates. Well, that's great. Any high oil price rates, and that's what's happening at the moment. When we go through the rest of the news, there isn't something particularly worrying because the profits are there. It's the profits. And if profits exceed expectations, then prices go up. If profits don't exceed expectations, stock prices don't go up, but it's a short-term problem. If there are no profits, you've got a long-term problem. China and the US apparently have come to some kind of deal. We don't need to try and read that. What we need to read is it going to cause a problem for the stock market? Not today. Fine. That's it. Don't overestimate and try and over-understand things. Okay, what else do we have? Well, the S&P all-time highs. Is it expensive? Well, it's the S&P, as I've said for a long time, is obviously just it's 7 stocks. It's the 2 M's, 3 A's, Meta, Microsoft, Apple, Amazon, and stick in there NVIDIA, and that's the S&P 500. So if you want to beat the S&P 500, you're going to either have to be rather concentrated in those stocks, the ones that I talk about every single darn week, or you're going to have to leverage on the S&P, which is another way to beat the S&P. Okay, but if you're going to buy S&P companies which are not measured in the index, thinking you've got the S&P, you haven't, right? So let's move on to what else. Now, you've got to read all of this. This is not a solicitation to buy or sell any particular stock. One thing that I wanted to draw to your attention is just how absolutely appalling fund managers are. This is the percentage of US equity funds underperforming their benchmarks based on absolute returns. 93% underperform over a 15-year period. Over a 20-year period, 94%. I mean, even over a 1-year period, 3/4 underperform. Okay, and that's just the way it is. By the way, if it's large cap growth funds or S&P growth, 92% will underperform the benchmark. You're better off doing it yourself, is the bottom line message that I want to give you. The other thing I want to give you, which is a bit counterintuitive, is when declines happen, the recoveries also happen. So what is it that's causing you to either panic and exit soon or get bored? Well, usually because you don't have good quality companies or you put too much money in them. If you put the right amount of money so that when they fall, you allow for that fall and you don't need to panic, and they're good quality companies, then you neither panic or get bored and you make those returns. So the key question then becomes with investing is, well, how do we find those quality companies? And that's my job, and that's what I'm going to talk about in this video, okay, in this live. Now, it's historically normal for large down days to happen. This is when the panic happens with people. The panic happens when these large down days happen. And my job is to make sure that with my clients, we handhold them, we give them the data, the understanding, so that they don't panic when this kind of scenario happens. And it will happen a lot. But people will turn around and say, well, wait a minute, aren't we overvalued? Foolishly not understanding that valuation itself is not the only measure of what moves stock prices. What moves stock prices is not just valuation, momentum, growth, revenue growth, earnings growth. You can have something which is very highly valued, but if it continues to produce profits because it's in a near monopoly position, such as an Amazon, an Apple, an Alphabet, then you will continue to get prices to rise. And it's that lack of ignorance. It's the bit they pick up from here, there, and everywhere, and then trust an IFA, or God forbid, trust St. James's Place. That causes them massive problems, and they don't get the returns they were expecting. By the way, I did want to show you gold, because why not? Now, I wrote in a column in the Financial Times many, many years ago that about 5% of your portfolio in gold is fine. And the reason is, I think I wrote about 25 years ago, and it's all in here. You can get the free stuff from my book, Investing Unplugged, and the link is up there anyway, whenever you see it on screen. But yeah, about 5%. If you go all in, you're probably going to then gamble, because you're going to hope then gold price keeps rising. Whereas if you're holding 5%, you're using it rightly as a diversifier. By the way, something else I want to show is many of you will be in your 30s, 40s, 50s. Most of my clients and the people who watch what I do are very often professionals or business owners who sold their companies for, say, 10 million plus. At the other extreme, I've got people in their 20s who know they're going to earn more money and want to start early. Now, if you're one of those who are starting early, this is, now you might at 22 not have 275,000, but you get the point of what we're talking about. Now, 8% annual returns, I'd be very disappointed with, not least because an index like the S&P gives 15% per annum over the last 15 odd years. I'd want to try and get closer to 20, 25, 30 if there's a tailwind. Last few years have been good thanks to the market, not thanks to my skills, and therefore even 40% have been possible, which will make up for lower return years. The point being, look at how much that grows if you leave it alone, if you're not trading. And that's why the point I made earlier about people wanting to trade because what they see on social media is it's a gimmick from brokers who make lots of money. Just, I think you better start avoiding some of the trading, particularly leverage trading anyway. Okay, so where are we on the markets? The US market happens to have consistently outperformed the rest of the world. Yet people will constantly say to me, why are you picking US stocks? I'm not. I'm picking companies which are the very best based on valuation, growth, dividend yields. And if I look at all the global companies and then look at the data based on value, growth, income, cash flow, Sortino, if they happen to be listed in the United States, which by the way usually means they're global anyway, then so be it. I won't forcibly buy a British company, which by the way, the shareholders of most British companies, as I've said on Sky News before, are foreign, and those companies earn a lot of their income from outside the UK. So it's not UK other than where it technically legally is listed, i.e. regulated. So that's a bit silly saying, oh, well, it's a British company, I must be tied to Britain. The IFAs have learned from books written in the 60s, and they haven't got a bloody clue ever since, and that's why they're ignorant of that fact, and they'll call it diversification when actually they're not diversified at all. And we also know this because, again, I want to show you something else. If you go to my blog, you will see where I've written in great detail about that diversification issue. And by the way, written about it not just in terms of just an opinion piece, but actually with a ton of data. It's all free. Okay, campaignforamillion.com/blog. And you will see, this is from Goldman Sachs, Are We in a Bubble? And we've got all the data that is there. So if you go there, you will see all of this, not just on this one question of are we in a bubble, but also why are St. James's Place as a fund manager so rubbish? Why are other big name pension funds so terrible at what they're doing, institutionally incapable of beating indices just because of the way they are set up? They're not going to beat an index. Like I said, it is because of the way they're set up. Okay, one thing that I want to do right now is I'm also going to show you, we can't do it here, there we go. I'm also going to show you the fact that if you look here, you will see a ton of famous names. Fondsmith and why they're poorly performing. Templeton, why they're poorly performing. Scottish Widows, L&G, HSBC. It's all on campaignforamillion.com. It's all free, /blogs. But equally, I want you to go to these tools, apps we've created for working out your pension, stress testing your pension, working out how quickly you can get financial independence based on how much money you want to have at the end of your retirement, what age you are. It's all free. You move it all here. You can work out the growth rates and how quickly and likely you are to hit it. Okay, so it's all on campaignforamillion.com. Now, going back to market capitalization, it is not that I care that these companies are American or anything else. It is that they trickle to the top. It's like university admissions. Just because people happen to be of a certain nationality doesn't mean I'm positively discriminating in favor of them. That's often misunderstood. By the way, when the bear market happens, just so you know, 2004, I've got a lot of experience at this, whether it's speaking for Barclays or speaking for American Express on bear markets and so on. When that time happens as well, because everybody looks clever when the markets are rising, I just want to share the fact that, I'll know what I'm doing there. I want to give you something for a bit of fun there. Yep, that is me in GQ. I have also been in GQ when Emily Blunt was on the front cover. Whatever happened to her? Anyway, back to the serious stuff. Gold. Now, when that drops, and almost certainly it is going, it can't keep going exponentially, although I think AI stocks are about to do that because Bitcoin did it first, then gold. And this drops closer to, well, let's say a 70% drop in the market cap of gold. That's going to be one hell of an opportunity to short this and make a lot of money. It's not the moment yet. I'll keep an eye on it, but it's going to be coming. This is from Goldman Sachs Wealth Management. Are we overvalued? Are we overvalued? Well, they say, and they say the same thing I do, it's earnings. The earnings, the profits, earnings and profits means the same thing. Earnings are still there. Earnings are still there. So there's multiple reasons to think we are not overvalued. Okay, and that full Goldman Sachs report is on campaignforamillion.com. Let's have a look at the S&P 500, the way I conventionally do when we're looking at stock market weekly updates. Yes, we are at all-time highs. That is arguably a hanging man Japanese candlestick. If you don't know what the hell that means, don't worry about it. It's what Japanese rice traders used to use to look for pattern recognition in price moves about 300 years ago, and it still has some element to it. This is an engulfing bear and was the peak of the market. That could potentially be the peak of the market, if I call that right, but I'm not calling it at the moment. What I'm saying is we don't even have a daddy bear. All I'd say is be careful. Now, see that peak in the past, that presaged a fall. See that peak in the past, that meant a fall. Okay. Now, does that guarantee it? No. What could happen? Well, there's a minority case to be made that it's going to continue going up. As things stand today, let's see whether that happens. There's a lot of earnings still coming out. Okay, look at all these companies and all their earnings that are still yet to come out. Okay, that means that we've still got a heck of a long a heck of a long journey to go in terms of seeing whether or not we've peaked or not. Now, a lot of these companies, they're not going to move the market. So in a way, it doesn't matter. By the way, this is the past week. The markets, that's just noise. I know 11% on Google, Apple. That is what makes stupid gamblers want to trade in and out. If you want to trade, go ahead. I think it's a damn fool silly thing for most private investors to do who don't have the education and the information with which to do it. I think it is stupid for them to do. So instead, let's have a look at the investing side, which means slightly longer term. Nvidia, 44%. I happen to own, as you will know, JP Morgan, Goldman Sachs, obviously Nvidia, Meta, Microsoft, Apple, Amazon, Alphabet. It's in the public domain. I happen to own some other companies, which my clients know, and they know my model portfolios off the back of this. And you can see why. If it just so happens that the companies I have are American, so be it. And you can see a lot of the red numbers. Now, some of you will start saying things like, well, is there a sector rotation? And using phrases you don't quite understand. It's irrelevant. We're looking for good companies, irrespective of sector or geography. We're looking for good companies. Companies. We want to buy low, sell high to make profits. Companies matter. You might say, well, surely a country matters, a sector matters. Yes. So does the color of my underpants matter, I'm sure, in some almost irrelevant way to how a stock's going to move. And that's the problem. People give too much weight to things which aren't important. So how do we know what's important? You look at the data and the analysis, and the analysis that we rely on a lot of is a Nobel Prize winning economist, Eugene Fama. We also use Richard Taylor and Daniel Kahneman. I'm hoping one day Terence Odion will also win the Nobel Prize in economics, because I've been using his material for a number of years, 25 years. And the other three economists I talked about, I've been using theirs, and they did go on to win it. Here's your ETFs for you. Okay. And what you can see from the exchange traded funds over there is, I'll do separate videos on this, is that there's not been much movement over the last month or so, other than, as you might expect in anything with leverage, and of course crypto had a heart attack. If you're looking to trade, you are onto a hiding, okay, because the traders are going to lose money. Over the past year, if you just sat still and didn't try and trade it, and most private investors shouldn't try and trade it, and the Nasdaq's up 25%, okay, over the past year. Yes, there were periods of panic and there were periods of boredom where it went sideways. If you can avoid the boredom and the panic, you are absolutely laughing. And that is the trick. And that is what I try and give people calm assurance on. What kind of stocks? Well, I've said it before. I'm going to say it again. My students will know this. I don't own Mondelez, by the way, but the others, yes, I happen to. Okay, and that's fine. Well, wait a minute. They pay you the big bucks for coming up with names everyone's heard of? Yeah, I'm afraid so. Okay, if that's the way the universe is at the moment. This is the UK ones. I don't own any of these as it so happens. I'll do a separate webinar on the UK. The FTSE 100 is doing what I think might actually end up happening with the US markets. What the FTSE 100 is doing is, if you look at this, in the past, it's fallen. When it's gone near a peak, historic peak, it's fallen off. Okay, the prices have tended to drop. Prices have tended to drop. Prices have tended to drop. This time, it's just cleared straight up. Okay, after that one, it's just cleared straight up. Now, if the Nasdaq and the Dow do that as well, we're all going to have an early Christmas and make a bucket load of money. But I just thought I'd share with you, and it might be that the FTSE is presaging what's going to happen. A problem at the moment a lot of people have is depicted by W.R. Berkeley over here, which is a bit like with the FTSE 100, has had a long period of gains and is overbought. Now, the worry is, well, wait a minute, historically it's tended to drop. It's had these falls in prices, okay? And if it's had those falls in prices, aren't we about to get them again? Okay, yes, we might get them again. We do not know. There is no guarantee, okay? And that's what's causing a lot of people concern and worry. And if you are risk averse, you would stay out of the market. If you're risk loving, you'd go in. And if you're in between, which most people are, you would toe dip in slowly, adding to winners. That gives you a simple strategy. This is also from W.R. Berkeley. And if you look at it, you can see there are relatively few companies with return histograms which look like this. Now, notice how you can have a 9% loss in one day. What that means is small probability of a big loss. That causes panic. But if you look over a longer period of time, you've got a massive greater probability of a gain. That's why buy the dip strategies work so well only with stocks which have return histograms similar to this. Okay. And you want to invest in those kind of companies. So we look at statistics, not just undervaluation, revenue growth, dividend yields, Sortino and Alpha. And I'll look at some of the other things and show you some of the other things as well that we like the look of. Now, T-Mobile, at the moment, I wouldn't buy. Longer term, we've held and had it in model portfolios. I wouldn't buy it today unless I was just picking up a portfolio knowing that, yes, some will rise, some will fall, even though Morgan Stanley have given it a buy rating. And the reason is if the monthly momentum, and you can see it there, the monthly momentum is downward, that usually means that the price is going to find it difficult to rise. And why would I buy it today if I can pick it up cheaper later? Although I know, and this is the ideal scenario to buy, when it's just starting to rise in that kind of a pattern. So again, we're going back to pattern recognitions. And I think this needs to fall a bit further before that happens. So I'll give you an example of something I wouldn't buy today, but I know I will almost certainly later on, but not today. Take Lam Research similarly, or Walmart or Costco. There are others which have similar kind of reliable patterns, but I wouldn't do it necessarily right now today because I can pick it up a lot cheaper later. And when I look at their statistical distributions, that's a critical factor for me as well, not to panic if we're at those ends, even after 50 days, even after 100 days, because the probabilities are that buying those dips makes sense, but not quite yet because the MACD hasn't bottomed out. Okay. Now, let's have a look at Republic Services. Very similar. I wouldn't yet unless it was already part of a model, but not yet. Right, for exactly the same reasons that I've already just mentioned. And you can see the return histogram there as well, giving a similar kind of story. Don't forget, we also filtered these for undervaluation, revenue growth, dividend yields, and the like as well. Now, there's something else I want to share with you. I want to share with you some of the things I gave in a speech to Eton College who've asked me back to their Keynes Society. And I want to share with you basically everything that I've ever, everything I know, which I think is worth sharing. Now, let's be absolutely clear. This is, you know, what really probably happens every day. Okay, let that sink in a little bit and let's move on. Now, research from Joseph Marks, PhD. What factors gets people listened to? Charismatic messengers beat considered ones. The reason I mentioned this is on TikTok Live, it's social, and it'll be on YouTube as well. And people want to understand complex scenarios. And one of the best ways in which to do it is to focus on communication skills. And that's why I'm mentioning this. One of the other things I want to get across to you is there are something called hard and soft messengers. And there are time for soft messengers, there's time for hard messengers. We're currently obviously going through a period of hard messengers and having kicked out the soft messengers. Okay. And these are things worth learning. So these are things I was speaking to the Eton School students about, right? And I want to share it with you guys as well. Or as John Quincy Adams put it, if your actions inspire others to dream more, learn more, do more, become more, you are a leader. And a lot of people talk about leadership and what does it entail? That is it. Now, how are you going to do that? Well, Harvard Business Review discovered that charisma is something worth studying and is something which exists. And some of the things that help in determining charisma are the things that they've mentioned there. They assist. They get you to communicate better. Now, there are some of you who say, I don't want to do any of that. That's perfectly fine. You will be the poorer for it, and the rest of the world might be poorer for it because they won't hear your message. By the way, if anybody's bothered, these are my two ambitions, to get into one of those two lists. Okay, how's it going? Yeah, I'm still working on it. Judgment, I told you earlier, was one of the most important things. What's important? How important is it? Again, Harvard Business Review, hidden traps in decision-making. If there's something you need to learn, it is these things. I'm not going to go through them today, but I need you to know about these traps of decision-making. You need to learn about anchoring, status quo, bias, sunk cost. Now, people have won Nobel Prizes in economics for pointing these things out and showing how they impact decision making. If you want to get rich, it's not just about, please, Alpesh, give me a stock name. It is also about how these things cause you to panic and get bored and mess things up in your investing. Okay? Here's a message I gave to everybody, including the people at Eton School. Never underestimate the power of stupid people in large groups. Right? Now you might think, well, isn't that anti-democratic? Yeah, well, anyway. Surely the makings of a billionaire. That is me at the age of 6 playing chess. 19A Keller Lane, Leeds. I must write to them and let them know I used to live there, as if they'd be bothered. My first computer at the age of 9. This book isn't out yet, but it will be soon. The Financial Times are going to publish my book. It'll be my 19th one. We've had various funds in that we've launched, and they've been Indian, they've been private equity, they've been Eastern European, they've been environmental. We've got more coming. That is the day job for anybody who wants to know. When it comes to investing, it often ends up looking like this. Okay, it often ends up looking like that. It's not whether you're right or wrong, as this familiar face said to you. It is how much you make when you're right and how much you lose when you're wrong. The biggest mistake private investors often make is they will sell their winners because it makes them feel better and double down on their losing investments instead of the other way around, or they will panic and get bored. If you have good quality companies, you don't need to panic or get bored. And that's why, coming back to that point, it is incredibly important you have good quality companies. Now, there are those who think investing is about trying to understand all of this. Now, I've got a master's degree in economics, and I can tell you it is not. Once you have worked out that value, growth, income, cash flow, Sortino, alpha are the most important things, everything else becomes less important. Everything else becomes less important. Okay, and as I explained earlier with these points, that's Bill Lipschutz's hedge fund. That's its monthly return distributions. If you ever wanted to know what are the return distributions of a hedge fund, that's what they look like. That is what we're trying to get to. Whenever we get to that in our investments or our trading, that is the road to making millions. Okay, people go, oh, it's compounding. Well, before compounding comes this. Now, the mistake retail clients make is they think you've got to be right all the time and win big all the time. That's the stupidity of retail clients. They will also not add to their winners, people like Bill Lipschutz will, and they will instead add to their losers. So they'll have big losers and few big winners. The exact opposite of what wealth looks like. What you see on screen is not my hedge fund, it's Bill Lipschutz's hedge fund. Actually, it's what every hedge fund eventually looks like. It will look like that in terms of monthly return distribution. When people write to me and say, oh, I've got a great idea for a fund and we're going to do this, 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 I ask them to send me their monthly distributions. And what you find is if it doesn't look like that, then they've got a problem. There's another piece of information I gave them at Eton, which is this. There are 3 ways to get what men get men, ways that men get what they want. 1, planning, 2, working, and 3, praying. Plan and get that work done. Can you outperform overpaid fund managers like that idiot over there, Neil Woodford? Yes, you can. Notice how he narrowly beat Jasper the cat. Okay. I want to tell you something. That was 2004. That was 2004. What happened in that period from 2004 when he narrowly beat Jasper the cat to forecast the markets is they gave him 9.2 billion. That should tell you something about my industry as a whole. Not only is it full of people who can't do the job right, but also it's full of journalists who will build those people up. So be warned of the big marketers, the St. James's Place, the Avivas, who spend lots and lots of money on marketing, millions on marketing. They're outgunning people like me. We can't spend as much as they do to tell people the way it is. Okay. Again, from Bill Lipschutz in my book, Mind of a Trader, Hedge Fund Manager of the Year. Recently, he was as well. What I want to leave you with is also this thought. That's me after my final exam, Red Carnation, last exam. Warren Buffett said this. If you've got an IQ over 120, it's wasted in investing, i.e. clever is irrelevant. Okay, above 100, you don't need it. This business of investing is actually a lot simpler than people realize. There's my mum. It's a lot easier than people realize. These were some of the studies that we found. The results from a massive study of 200,000 respondents revealed that being generous had a positive effect on one's happiness in a whopping 93% of countries. Notre Dame researchers looked at generosity indicators such as giving money, volunteering, and even being emotionally available to friends, and found that the more generous people were, the happier they reported feeling. Here's another one. Sports cars, psychopaths, and testosterone. Institutional investor research papers like that show initial success is a bad predictor for investors. A hedge fund manager who drives a Ferrari will probably underperform. Psychopath hedge fund managers make less money than nice guys. Alpha males make bad hedge fund managers. In other words, narcissism, Machiavellianism, and psychopathy lead to worse hedge fund managers. There's a research paper on this. They will drag you down. It's not obvious. And the same thing happens in politics. Character. Of course, rich does not make you a good person. A series of studies conducted by Paul Piff and his colleagues from the University of Berkeley. In one study, participants were paired to play a game Monopoly. The game was rigged so that one of the participants quickly became wealthier than the other. The researchers then observed through a one-way mirror the participants' behavior. It turned out the wealthier a participant grew, the meaner they progressively became. For example, the wealthier participants started assuming more dominant postures and began talking down to their poorer counterparts. It's a freaking game with artificial money, Monopoly, and they were still doing it. So it was a warning shot to my friends at Eton. These are slightly older ones, slides that I did in the past. Okay, what I want to show you is not that. What I want to take you to, the sleep well model. Oh yes, little pussycat. This is the checklist that I would use. The companies have to be undervalued, they have to be growing, and they have to be dividend yielding. If you've got an IFA or fund manager who says to you, don't worry, you're diversified because we've got a valuation fund, a growth fund, an income fund, a momentum fund, they're absolute idiots. Okay, it has to be all of those things in one. Every company you have has to be the best of the best of the best. Ask them statistically, why would putting in something which is rubbish make something which is suddenly good? It doesn't. Now, I know there's a lot of data out there, but in actual fact, you need to remove what is relevant from the irrelevant. What is relevant is valuation, revenue growth, dividend yields. What we look at is valuation, revenue growth, dividend yields, cash return on capital invested, momentum, Sortino, which is high average returns with low downside volatility. In other words, if that's the direction of travel, whenever it falls, it whips back quickly. In other words, it's underwater for a very limited amount of time. Its drawdowns are limited. That's what Sortino measures. Well, wait a minute, Alpesh, but you didn't talk about AI in all of that. Don't need to talk about AI. If the company has that level, that characteristic, that is good for your investments. Of course, on a discount cash flow, if it's also undervalued and has histograms like this, even better. Notice I'm talking about statistics as well as valuation, growth, and income. And here's something which might worry the bejesus out of you, and it should. Drawdown recovery maths. Yes, if you're down 25%, and Warren Buffett has 3 times in his career been down 50%. Yes, you get worried that you've got to then double up, but it happens in investing. In trading, it's a lot more difficult. So if you're investing, less of a worry. If you're trading, more of a worry. Let me share something else with you. This is from when I used to lecture at Oxford on behavioral finance. Research in behavioral finance found that 39% of all new money committed to funds went into 10% of funds with the best performance the prior year. Despite evidence, this is a sure way to poor performance. People gave it to the last year's winners, even though all the evidence shows last year's winners are going to underperform the year after because they were last year's winners by chance. And the marketing agencies will just double up when that happens. So be warned, I am telling you now. Okay, now this is a lot to read. The problem, it is better to be born rich and stupid than smart and poor. Gifted children from poorer families are less likely to graduate than wealthy but low achieving students. That's an NYU study of 1 million genomes. Okay, Kevin Tome did that research. Billionaires were in the top 1% of IQ in another study. So there is a link between money and wealth. Luck. The maximum success never coincides with maximum talent and vice versa. This is academic research. Some talentless dimwit basically will be swimming in wealth. That will happen. The 40-year study on luck found this. So maybe I'm not rich because I'm unlucky. Napoleon, I'd rather have a lucky general than one that's good. There is an element of luck, so don't beat yourself up. There is also an element of IQ. IQ does determine how much money you have, but it's not the way you think. It is not a linear relationship. The incredibly clever often end up as professors at Harvard and have the worst cars and don't end up rich. They may be beyond money. The incredibly stupid have no money at all, unless mummy and daddy gave it to them. So it tends to be like an N curve. Okay, skewed towards higher IQ, but then wealth drops off as your IQ increases significantly. Financial success, according to academic studies, is more connected to self-discipline, perseverance, and diligence, the things you'd expect it to be connected to. Okay, now let me give you a couple more. Personality, motivation, and conscientiousness is generally more predictive than IQ of a variety of important life outcomes. Now, the reason this is important is because personality can be changed. Motivation and conscientiousness can be changed. IQ is given at birth, probably can't be changed. Okay, this is important. Partner conscientiousness, the person you marry basically, is incredibly important for predicting likely future success, not least because divorces lend themselves to greater poverty. So how might you get more lucky? Well, improve your personality is one. Be careful who you marry is another. And thirdly, be in a position to be lucky, i.e. network who you know. IQ, you can't tend to control. The money you're born with, you can't tend to control. So there are still advantages to you nevertheless. Can more information lead to better decision-making? Now, this is the lectures I used to give at Corpus Christi as a visiting fellow. And what we found from academic research is more information doesn't lead to better investment decisions. It leads to a sense of overconfidence. People were always looking for the holy grail from magazines, articles, social media, TikTok lives. It didn't lead to better decision-making. It led to an overconfidence, a lack of humility. So another warning I wanted to give people. And men tend to be far more overconfident than women. Okay, I also want to show you a money management experiment that was done. If you have 10,000 hypothetical money to trade with and have 100 trials in a game in which 60% of the time you can win. If you win the amount of money you bet. And if you lose the amount you bet. Out of 40 PhDs, only 2 made money. But the game is skewed towards, think of it, it's a bit like investing. It was skewed towards making money and still only 2 did. And the reason is if they had a string of losses, they just exited and they bet too much money and overconfidence. A 1985 study in Sweden found that middle-class, middle-aged male professionals were far too confident, but Swedish housewives were far more rational. They made actually, and women often do, made for better, let me finish that sentence carefully, better investors. Swedish housewives made for better investors. They were more rational, less overconfident. Now, this was another important one I wanted to show the students at Eton. Does risk double with 2 investments? No, risk can actually become lower with 2 risky investments. That is the essence of what Harry Markowitz discovered and got the Nobel Prize in economics for. That is what we're trying to do when we're creating efficient portfolios for our clients in the Great Investments Program. We're trying to add assets which are likely to go up. And even if they're volatile, by adding them, reducing the volatility and still getting the same return. So removing the alpha for the client, but still getting the returns. Whereas the client thinks it's all about some magical company, no matter how steep the ride, how crazy the ride, they've just got to stomach it. In actual fact, it is not. Partly for this reason. We're trying to avoid clients falling into this very common trap, which happens very often. I won't go into purpose autonomy. It was something else, in leadership and management. I'll probably do that in future ones. I did share with them this that I got from Goldman Sachs Wealth Management. If you know me, you've seen it before. CROCI, cash return on capital invested, probably the most significant slide. If you left me on a desert island, just give me this and some money and I'll make my own private jet. 30% per annum of the returns for companies in the top 25% by amount of cash they can generate from capital they put in. Think of it like capital being a cash producing machine, the license to print money, and cash flow being the money that you're printing, 30% per annum. That was critical. And that's why we use little holy grails like that. And usually about 20 to 40 stocks. And as you get older, more in cash, but still 20 to 40 stocks, but more in cash. The major problem in the UK has been, and this has widened, other than this past year, has widened every other year, has been this gap between the UK and the US. Okay, so that's the UK, minus 12% from the 5 years to 2020. America doubled. The American pensions doubled because they tended to track their domestic markets. British pensions went nowhere because they tended to track their domestic markets. It is a major problem I'm trying to solve by getting this message out to as many people as possible. And here's a typical fund on £10,000. Average return each year is about 5%, I'm afraid. That is the British disease, even though I just showed you that those are the kinds of returns Americans are getting. The British disease has become getting 5% per annum because the wealth managers are shoving it into British companies and British funds, and they just haven't got a clue what the hell they're doing. Okay, this is one of my most important formulas. It's what we use in the hedge fund industry. We want high upside return, low downside risk. In other words, we want companies which are most likely to snap back if they fall. Now, I know there's a lot of information out there. Beware of noise sucking you in. It's always good to look at, but don't be sucked in. Some of my favorite books I'd like to also leave you with that I like. If you don't like reading, try listening to them. And I leave you with one final thought. Mistakes. It could be that your purpose in life is just simply to serve as a warning to others. And if it is, never mind, at least you still served a useful purpose. Thank you.